Okay. Is that coming through now? All right. Hey, we are working on our technical skills here. Looks like we got it figured out. Hopefully everybody can hear me now. Let us know if you're not. If it's sounding good, well, let's get going on this. I'll give you a little bit of background to us as Diversified Wealth. As a company, we are all education-based. We work with other groups, many different groups actually, in handling education when it comes to investing strategies, and particularly investing strategies that you can apply to your IRA, self-directing an IRA, that is. And looking at non-traditional ideas and strategies, there's some very basic philosophies that we believe in that we're going to go through today, and then we'll get more specific towards the end about some basic ideas that you can apply. And much like Derek had mentioned earlier, there's a lot of opportunity out there for all of you to take advantage of some training courses and training that we do, as well as what iPlan does. So there's a lot of things that you can do to get involved and find opportunities and really start, as this is stating, taking control of your retirement. So what we're going to do is we're going to start today and start talking about what is it that matters when it comes to investing, because there's some very basic things that we believe in. We're going to talk about the investing model. In fact, this is the traditional investing model. You are, for the most part, your retirement accounts are the investor. Now, there's some important things we have to understand about the investor. 3 things, in fact. Number 1, as an investor, you assume all the risk investment you're in. Number 2, you pay all the fees of the investment that you're in. And number 3, you are always the last to get paid. So think of the obstacles that you deal with as an investor. First, the investment that you're in. Big obstacles. It's one of the big reasons why most people do not experience build in their retirement because you take on so much of the responsibility when it comes to the risk and the fees and the ups and downs. You should might be able to advise you in investments, and they are going to always be paid in commissions. Whatever the investment produces commissions, can make obviously a salary from that, or they get commission. Who's paying for that? The investor pays for that. They pay all the fees. Now here's where we start to get kind of an interesting point here with this. We talk about the company, XYZ company, banks. Well, they're creating the opportunity. They are the ones who are providing to provide. So when they create the opportunity, they create the conditions of the opportunity. Well, if you're in charge of your own opportunity, well, of course you're going to make the opportunity work in your favor. So it's first, and always going to be protected first, no matter the case. It doesn't matter what investment we talk about. It doesn't matter what genre of investing, stock market, real estate, whatever the case may be. If you are the investor, this is how it will always be. And the company that is providing the opportunity to you will always look after their side of it. So there's some really big implications for this model that we got to understand, particularly as we start to talk about what can we do differently in our life. These implications come from this diagram, and this is what we really think is important for investors to understand. Number 1 is that wealth is built on the right side of the equation. Where the company is. That's where wealth is. And it is because wealth equals control. You'll hear me talk about control more than just about anything else. If you are not in control, you do not have the ability to build wealth. And when I say control, I mean the ability to influence the investment, the ability to direct the investment the way that you want, make decisions that you want, not merely buying and selling stocks. To us, that is not control. Okay, a couple of other things about the investment model. The incentive of a company that's on the right is not consistent with the investor, right? Because the company wants to make money. It needs to make money. And because it needs to make money, it makes money from what you invest. So they never going to tell you to do anything different. But what makes the money? Well, it makes absolutely no sense. Okay. the company's wealth is built off of the investors. So as we look at this, the incentives that are absolutely key for this are going to be what we need to look at in order to be in a position to build wealth. The incentive has to work for you. It has to be working for you, because if not, if the incentive is opposite of you as an investor, you're always going to be left on the outside looking in. And then finally, and kind of goes along with what we're talking about with the other ones, is the broker and the company, their business model depends on you staying as an investor on the left. They do not want you to take control. They do not want you to get outside of that model. They don't want you to do anything different. They want you to stay where you're at. Their profitability depends upon it. Okay? So these implications are key. And when we start to talk about strategies, and we start to talk about, well, what can we do different, and how do we create incentives that allow us to be in control? So this is where we start to get into the you can sell a stock. It means you control the assets you invest in. Okay, we got to start to think and act like the company. Whatever that company is on the right side, whatever it is they do, insurance companies, banks, they're doing something that is successful and is profitable. And if we can learn their strategies, we can do the same thing. We can be in their same position. Okay, big thing. I plan we'll talk to you about this. We'll talk to you about this as well. Empower your IRA accounts. Get self-directing them. Get into a position that you can take control where your money's at and the assets that it's in. Okay, and then finally, learn secrets that brokers and financial advisors and financial companies, they don't want you to know these things. It does them no good. You've got to get into a position that you can educate yourself to do it. So it's kind of a long run into the idea now of trust deed lending, because as we start to break down this model, how do we move to the right side then? If that is where wealth is built, if that's where we can take control, how do we do it? What kind of strategies help us get there? Okay, we teach a lot about trust deed lending, and it is because lending is one of the quintessential strategies of the right side. It is something that anybody, anywhere can do, but you've got to learn some basic rules with it, and we'll start talking about some of the basic ones here today, and then obviously for what we do as a company, we can do further education and training with you to help you understand fully how to be able to do this. Okay? So there's some basic conditions. If I'm going to lend somebody money, I want certain things in return that both protect me and profit me first. So there's 5 of them. Here's rule number 1. Rule number 1 is that we are going to take assets as collateral, right? The bank lends you money for you to buy your house. What does the bank do? They take your house as the collateral. They have a first lien position on your house. Now this is really key, first lien position. It will ensure that you are going to be paid first, you will be paid profits first, and you are going to be the last one to lose. Direct opposite, right, of where investors are now. So first lien position guarantees us to get paid first. That is a rule, that is a condition that cannot be changed. Rule number 2 is a loan-to-value ratio. If we get into this idea of lending, where I'm going to lend somebody money for their investment, for their project, for their business, whatever it is, and I've taken a first lien position on their collateral, usually property, then I'm going to only lend them less than 65% of what I think that property is worth. Take a hotel, take an apartment building, take a gas station, take just a residential property. You figure out what you think it's actually worth, and you only lend them 65% or less of what that house is worth. You've just built yourself a cushion. You've just built yourself a cushion. Because think about the opposite. If I buy a stock, I buy it at its market value. And if I buy it at its market value, I have to sell it for more than its market value to be profitable. Here, I don't have to do that. Right? In this situation, because I've only lent out maybe half of the value, that property does not need to go up in value for me to be profitable. It can even go down in value, and I can still be profitable. That's an amazing, amazing aspect of an investment if you can get that. The asset can go down in value and I can still make money. Not bad. So loan to value is key. What do we think it's worth? How much are we willing to lend? Okay, on cash flowing assets, that's acceptable. Non-cash flowing assets, preferably below 50%. Okay, rule number 3, rate of return needs to be 12% or better. Now, this is just a preference on my part and the kind of things that we teach. 12% is a good starting point for the kind of return you want. This is very much associated with the interest rate on these kinds of loans, because keep in mind, as we talk about this, and we do some more training on this with all of you, we're not talking about bank loans. We're not talking about 30-year mortgage. We're talking about investment-style loans, the types of loans that investors get, the types of loans that business owners use. They're always going to pay higher in interest. 12% is a great place to start. It gives us a good foundation and a good place that we can work from. So you can see we're starting to build a pretty profitable scenario here. If we get first lien position and we're at a 60% loan to value and we got a 12% interest associated with it, we're in a pretty good spot. Now, rule number 4 fits along with this as well. We are talking about very short-term loans. Some people call them hard money loans. Some people call them bridge loans. Okay, they all fit the bill here. These are short-term situations that a borrower wants to borrow this money at a higher rate of interest, but 6 to 18 months is the time period. That's the term. They need that much time to either sell the asset off to pay us back, or generally speaking, they're going to look at refinancing into long-term conventional financing. So this is helping them bridge that gap and get there. Okay, so short-term is what we always want to look for. And then rule number 5, and really this is the most important, and this always ends up becoming a preference of mine as well when I do these types of deals, is that owning the asset needs to be a profitable outcome. In other words, I am not making my decision based upon whether or not the borrower is going to pay me back. I'm making my decision based upon whether or not the asset will pay me back. And that's such a huge difference, because now, truly, I'm in a position, if I follow these 5 rules, I am in a position to where I don't care what happens. The borrower can pay me back completely. I just made a 12% annualized return. The borrower does not pay me back, and I become the owner because I'm first lien position, so I get the first rights to the property. I am the owner of a property that I had already determined was a good idea to own anyway. I mean, imagine if I owned an asset for 50 cents on the dollar because they didn't pay me back. I can make good money from that. Easily a 12% return, usually better than that. So rule number 5 for me really is the most important one. It takes everything into account and allows me to say, I want my worst case scenario to be the borrower paying me back, and my best case scenario, I become whatever the asset is, gas station, apartment building, condos, office units, some sort of residential development, I don't care what it is. I've already looked at it beforehand, and it is what I want to become the owner of. These are some very basic rules. This is the framework for it. The details of the deal will be the main part that fits around these, but this would be the framework for any project from a lending standpoint. Now, there's obviously a lot more to this. That's not something that we can do all tonight. We don't have enough time to go through all the aspects of how this works. That is the reason why that we put together training for everybody that wants to do it, has a desire to it. We can teach them how to do it. We can teach them how to take this basic framework and really apply it. And then a company like iPlan, who all of you should take the strategy session with them and learn about self-directing an IRA. An IRA can help you then engage these kinds of strategies and learn how to really start taking control. So we have an education program that helps everybody learn these kinds of strategies, not only just traditional strategies, help people understand if they have mutual funds or annuities or other stock-based investments or bond-based investments. We help them learn more about them. We also help them learn about the basics of real estate and the basics of lending, which in our case, we believe it's the best place for anybody to start. Even experienced investors, people who have been doing real estate for years, still do lending because it is the simplest and easiest thing that you can do to make a 12 to 15% return. All of our education with anybody in our program is 100% free. Make sure I repeat that to you. It is 100% free. There are no costs to it. So don't worry about it costing $1,000 or $10,000 or whatever, or seminars you may have been to, or whatever the case may be. All of our training is free. All of our training is open to anybody who wants to take it. You just have to sign up for it. For this webinar tonight, we do have a series of DVDs that anybody can have. If you sign up for the training, we will send one to you. You can go to our website right there, diversified-wealth.com/dwsforum.html. You can sign up there, and we'll call you, and we'll go through some consultations and trainings with you. You can also just call us. There's our phone number. And you can ask for me, Ryan Robertson, or you can just ask our receptionist that you're calling about some free training, and she can get you in touch with some of our wealth coaches. We'd be more than happy to talk with anybody about any of this. And again, want to reiterate, it's all free. You got zero to lose. If you're thinking about self-directing an IRA, if you're thinking about changing, if you want to learn something new, this is the training for you, absolutely. This will be something that you can learn a lot from. And then at the bottom, Derek had mentioned this to begin with, there's where you can sign up for iPlan's strategy sessions, give you some information more about self-directed IRA. Again, I encourage everybody to sign up for this. You've got absolutely nothing to lose on any of it. I'm sure we'll email this information out to you afterwards, just so you've got the email and information there that you can do this later on. So that's all that I've got for tonight. I hope it was didn't go too fast, and I hope the technical stuff didn't throw too many people off. But if there's any questions, I'd be more than happy to spend enough time to answer anybody's questions they may have about this.
Yeah, I just wanted to say thank you to you, Brian, again. This is some great information, and it's amazing that they're able to offer all of this to you guys free of charge. It just really shows how much there is out there for everybody to learn. And we also have Erica Kelly over here on our side, so if there's any self-directed IRA specific questions, feel free to ask those as well, and Erica can get that answered for you. We have recording this webinar, so I will be able to get a copy of this out to everyone, along with both Ryan's information and also a link to our strategy session if you need it. I will be sending that out to you guys here in the next day. So we've got one question coming. So it says, I don't have a lot in my IRA. Can I invest in trust deeds with only $8,000?
That is a tough one. The answer to it is yes and no. It depends on what kind of assets, what kind of loans are out there. For the most part, it would be tough. You may need to start small. There may be some opportunities that you could do that with, but with an IRA that size, it might be kind of tough. I would probably just spend some time with us, and we can help you navigate some strategies that might help and might make sense for you. So it's kind of a yes and no without really getting into it with you. But I would say it probably is difficult being at that level. Probably if you get up to the $25,000 level, it's a little bit easier to do.
Gotcha. We got a hardball question coming over for you, Ryan. They want to know what the catch and how do you guys make money if you're offering everything for free?
Sorry, I didn't hear you very good, Derek.
We had a question asking, what's the catch?
What's the catch?
Yes.
Is that what they were asking?
Yes.
Well, the catch is that you get training for free. We have a system in which we help people learn how to lend their money. Now, we're not just saying, here's how you do it, go do it. We actually help you do it. And the profit for us, or the money that we make, comes from the deals that we do with you. So that's why the training is free, because we don't feel like we need to charge you to do it, because people that are intrigued, interested, and want to be a part of it and actually do it, we can help them do it, but then it helps us do it as well. And so we make money from the deals just like you do. So you don't pay us a thing for it. That's why it's free.
That's awesome. Thanks, Ryan. So, yeah, hey, feel free to send any questions over here. We got Erica. She's answer some questions here, too. So if anybody has anything self-directed IRAs, she's here to answer. Ryan's going to stick on the line here for a few more minutes. So feel free. So we're going to wait around here for a second, let you guys throw some more questions out. But then again, like I was saying, I will make sure to send out a recorded version of this call to everyone so they can walk through the PowerPoint along with both Ryan's contact information as well as ours. So here we go. Got another question here. What percentage do you make on the investments? Say out of 12%.
Hey, Derek, I'm having a hard time hearing you.
A little bit better for you? Can you hear me? Hello?
Yeah, I can just pick up pieces of it.
Welcome to GoToWebinar, web events made easy.
All right, is that a little bit better?
Yeah, that sounds a lot better.
I don't know what's going on here. 1 second I'm up and rolling, the next second I'm down. So we did have one more question come through for you, and that was,
Okay.
What percentage do you make on the investment, say out of the 12%?
It doesn't cut into your 12%. We can negotiate it separately from that. The 12% is an interest rate that you, as a lender, earns. Anything above and beyond that is something that we negotiate separately. So the deals come to us individually. The borrowers want to borrow that money based upon how much work we think we're going to have to do. We negotiate that with them. But the interest rate is all yours, all the lenders.
Gotcha. Currently, how many investors are you guys working with?
Right now, probably between 1,500 and 1,800.
And is there a specific amount per deal, or does it just depend?
Yeah, the average person is between $25,000 and $50,000 that they put towards projects. The average person has about $100,000, but they're putting about 25 to 50 per deal. You get to choose the deals that you do. You get to choose how much you put onto them, given those minimum levels. And obviously, self-directing an IRA is probably percent of the people we work with do. So we can help you figure out how that works for you too.
Great, great. Okay, got another one. Can I use my IRA, my friend's IRA, and cash for a deal if each party has $10,000?
Oh, I'd ask if that would work. Yeah,
Yes.
that'd probably work. I mean, every situation will be unique and different. So our biggest concern is that the people who are doing it are educated enough, financially capable of doing so, and they have a sense of what's going on. That's why we do education and training for it, to help prepare people for it. So every situation will be a little bit different. The numbers that I've mentioned are going to be not necessarily set in stone, but that's why we kind of go through the process to help. Because at the end of the day, the last thing we want is to have people doing things that they shouldn't be doing. And so we want to be able to work with people to help them figure out what is best for them. And for some people, it doesn't make sense. They shouldn't do it. So we would work with that, whoever that person is, we'd work with them.
Yeah, sorry to cut you off. I got a little excited there. We actually got a question come through for Erica. So Erica, can I use my 30K HSA to do trust deed lending?
Well, the HSA functions almost the same as a self-directed IRA. It's just that IRA is for retirement account savings. The HSA is for health savings. So same investments can be used. The HSA has enough money to basically lend, then the HSA could, in theory, hold a note and a mortgage. Loan the money, determine the interest rate. When the payment is made back on the loan, that profit goes directly back into the HSA tax deferred, basically.
Gotcha. Thanks, Erica. Yep. So, hey, we've got some great questions here tonight. I want to thank everybody for that. We'll still hang on here if anybody has anything else they'd like to throw out, and we can gladly answer that for you. So we'll give it another minute here to see if anything comes through, and if not, thanks everybody for attending. We'll get this out to you, and we hope you can join us on our next educational call. We're going to be doing a number of them with Ryan, so you're definitely going to get some more opportunities to speak with him and ask questions. So we got another one. Do you also work with cash, Ryan?
Yeah. Nothing exclusive about the IRA part. It's just that most people have retirement accounts. Most of their investment capital is cash is totally okay as well. Whether you've got trust accounts, whether you've got corporations or LLCs that own that, or if it's just a regular account that you have, savings or something like that, definitely that can all work. And, and I might add, which is the reason why, iPlan puts together the strategy session. If you've got 401ks, 457s, 403bs, simples, SEPs, those are things that you can talk to them about. Well, we can help you with that as well and talk about you can roll those over, particularly if you're 59 and a half. A lot of times your employer will allow you to roll your 401k even though you are still employed. Someone at HR or your plan administrator, they will know those kind of things. And you can set up a self-directed IRA, roll it out of that, no tax, no penalty, and you can start exploring these kinds of things. And so I really would encourage everybody to set up those strategy sessions and start learning about what kinds of options you have, and then we can help you a lot with some of the investment opportunities. I'll show you all kinds of opportunities that have been done recently and help you understand that part.
Great. Yeah, and just to add on to that, at iPlan Group, our goal is to help you and walk you through each and every process that you have to go through. So, we're going to make sure that you don't have to be nervous about if you're filling out forms correctly or not. We're going to make sure that everything's filled out as it should be, and especially when you work with some of these coaches, because we do work with them, and the reason that we found Ryan is because of some of the creative things that his students were doing with their self-directed IRAs. We make sure that everything is right and in order, so it does take a little bit of the nervousness out of actually going through the transactions. We did get another question here for Erica in regards to iPlan, and she's basically asking, do you charge a fee for each time that I would invest in a note, and if so, what would that fee be?
We have a flat annual maintenance fee. It's based on the account value. If anybody in particular wants this information, I'd be happy to send it out. We do not charge per investment or anything like that, so you basically pay a one-time fee to set up the account, an annual maintenance fee that allows us to allow you to invest in pretty much anything that you want, which related to this discussion, we would allow you to basically loan money out of your IRA to have profits come back in tax deferred or tax free sometimes. Other custodians like standard brokerage houses will not allow you to facilitate these types of investments because they don't have the know-how. So the fees are with respect to that. We're able to facilitate that and handle the paperwork and walk you through all of that. So if you want the fee depends on the amount of your account, and if you want the specifics of that, I'd be happy to provide that information to you.
Yeah, and as always, if anybody goes to our website, iplangroup.com, go into the section Online Forms. You can download any of our forms, applications, our fee schedules there. You can download it. You can take it with you. That's always there, but we can gladly send that out to you, and I will include that when I send out the recorded webinar session. So one more time, if we got any more questions, it looks like they've slowed up a little bit here. So I'm going to go ahead and give it a second here for everybody once more, and then I'll let Ryan be on his way here. But, yep, feel free to send any questions on over.
Hey, Ryan, I have a
Yes.
question.
Yeah.
I have a question.
Sure.
So in this strategy, just with respect to the question about partnering, say, somebody partnering their IRA funds with a friend and some of their personal money, How does that work with respect to the individual having a first position? Because at that point, would you basically be listing three, I guess, like interested parties or lenders on one note, or does each person retain a first position, or how would that work?
Yeah, so every loan, and this is really in respect to just about every loan that we would ever do, is what would be called a syndicated loan. So there is almost always going to be more than one person that lends. And so basically the legal term for it is going to be beneficial interest. So on the note and on the deed, every lender is listed with their percentage of beneficial interest that they have in the note and the deed. So if it was 3 different lenders and $10,000 each of them would have an equal portion of beneficial interest in that actual project, which of course if they foreclose would all transfer into direct ownership of the asset in their respective percentages. So a lot of times people call them fractured deeds. It's fractured up into percentages. Syndicated loan is another term for it, but each individual person would be listed as the actual lender in both the note and the deed.
Okay, I thought so. We don't have a whole lot of people that do that I've seen anyway, that are partnering in lending situations like, you know, this. Generally it's one person that's doing the lending, so that's interesting.
Great.
Yeah, it is somewhat of a unique strategy because it does allow people that don't have hundreds of thousands of millions of dollars to do it. You can do so with 20,000, 30,000. You can do so with 100,000 and break it up into several projects. Get the same protection as if you had all the money, but be able to spread your risk out, diversify what you do out. So it is a little bit unique in that way. There are other people that do it, but it's not necessarily the most common thing. But it is something that's common. I think most people, if they looked at their actual mortgage, you'd find there'd be more than one lender on your mortgage. It's common.
Great.
Okay.
So, okay, looks like we've slowed up here on the questions, so I'm not going to hold anybody up anymore, but I did want to say once again, Ryan, thank you very much for your time.
Appreciate it. Thank you as well.
And again, yeah, and to everybody on the call, we do encourage you to try to work with groups like this that are into educating and really teaching you guys the best strategies that are out there to really make your retirement funds work for you and to obviously optimize your investment portfolio to a level that you guys dream that it would be at. So once again, thank you very much. We hope you can join us on some upcoming calls. We're going to have a ton of more educational calls coming up in the near future here. So once again, from everybody at iPlan as well as Ryan, thank you very much for attending tonight.